Why is it the CME Fed Watch tool is only pricing in a cut by September for the Fed,
Mhm.
much later than the others? Yeah.
It's such an important question, and it gets back to the core of the interest rate sensitivity of the US economy, as well as the other things that we've been doing possibly to offset tighter monetary policy.
Inflation, growth, and monetary policy remain at the top of the headlines for investors. What's next? Cameron Dawson joins us. She is the CIO of NewEdge Wealth. Welcome back, Cameron.
Thank you for having me.
Let's talk about your big picture outlook first. So, monetary policy continues to, I guess, confuse some investors. On the one hand, we have inflation kind of softening around the periphery. We can talk about that. On the other hand, it's still higher than the Fed's 2% target. I'm talking about both core and headline. So, let's start with your inflation outlook first, and then we can get into what the Fed may do later this year.
Sure. So on the inflation front, we still see it as fairly sticky. We're calling it half of a Cinnabon. So it's sticky, but it's not quite hot, but it's warm enough that it doesn't satiate the Fed's desire to get inflation back down to 2%. You can compare our inflation path to other countries like Canada, our neighbor to the north, where they've had a much smoother path down in inflation. But what that means is when we look at measures like supercore CPI, for example, you can see that the disinflation progress that we made over the course of 2023 has really stalled out. And for much of the past 6 months, we've been stuck at this uncomfortably high level in the mid threes to high threes in supercore. And that supercore is core services X housing. So getting to the point of trying to remove as much of the whipsaw effects of inflation during the pandemic, removing the impacts of food and energy prices, removing the impacts of shelter, and just getting you down to those things that are typically more related to wage inflation. Those remain high, which just suggests that the Fed is not in a position yet to claim victory over inflation. And there was a great piece that the Federal Reserve Board of Governors put out over the weekend that talked about inflation dynamics when the Fed has cut and when they've been successful versus failing. And the Fed effectively is saying there's a chance if we cut rates, we could fail at getting inflation back to 2%. And that could raise the question of what would happen after that. Would you see the Fed actually having to return to rate hikes?
A few stats I want to bring up to your attention. So the first is that you brought up supercore. So here's another measure of inflation. The Atlanta Fed has what's called sticky price CPI and their flexible CPI. So the flexible cuts out stuff in the CPI that's not sticky, hence the other measurement. And it's just a weighted basket of items that change on a more frequent basis. Right now, that is hovering around 0.6%. It was at deflationary levels not too long ago. It's hovering around zero. So that's number one. The second thing is something called the truflation, which is another measurement done by not by the government. It's not an official government number, but basically what this index tracks is inflation supposedly in more real time, and that's around 2% right now, much lower than the actual headline CPI as reported by the BLS. So what's your reaction to these inflation measures that are much lower than what we're seeing in government numbers?
Yeah, I think that they are picking up on, and it's all how you weight the different items, which is
Yeah.
why they come to different conclusions. And there are some items, and this is a point that and his name is escaping me. Oh my goodness.
That's okay. It's Monday afternoon, and I know you haven't had your coffee yet.
So this is a point that Mike Green has been making, which is
Yeah.
that a lot of the drivers of the higher super core inflation are things like car insurance. And car insurance isn't something that necessarily spreads to other pockets of inflation. It doesn't metastasize. So he's in the camp of saying, look, inflation is going to continue to moderate. We should really be worried about growth. I would add to this question about inflation is that for the first time in a long time, we're hearing from companies about cutting prices. So you heard from Walmart and CVS and Target and Costco, the talk of consumers finally feeling pressured. But contrast that then with what companies are reporting about prices paid. We got PMIs this morning on Monday at 9 a.m. And what you saw is a continued elevation in the prices paid component in manufacturing PMIs, which just says that there is still input cost pressure on these companies. The catch is, though, they're not necessarily seeing strong growth. Orders were rather weak in this report, which suggests that even though there's input cost inflation, companies might have trouble passing that cost on to the end customer. This is very different than 2020 and 2021, where companies were able to pass on all the cost increases to their customers. Growth was so very strong. So then we have to ask the question, what does that mean for corporate margins, which is something we could dive into.
Yeah, we'll talk about EPS and your outlook for growth in just a minute. I'm just happy that Costco hasn't raised the prices on the $1.50 hot dogs, because the moment that happens, we know we're in big trouble.
Yeah,
Cameron.
the world is ending.
Yeah, yeah, for sure. Inflation, what is your outlook overall then, factoring everything that we've talked about so far?
I think that we're beyond the days of inflation being the key and ultimate driver, like in 2021 and 2022. I
Yes.
think that it doesn't necessarily, though, get back down to the Fed's target as quickly as they'd like. And the end result is that it challenges the Fed to be able to cut interest rates as fast as they'd like. And that was our call, since the beginning of the year, this idea that inflation would moderate, but would stay sticky, and then growth would remain resilient. When you put the two things together, that does not give the Fed the degrees of freedom to cut interest rates that it wanted to have, or the room to cut interest rates nearly as much as what the market had priced in, which, you go back to January, it was 6.5 cuts.
Why is it the CME Fed Watch 2 was only pricing it a cut by September for the Fed, much later than the others? Yeah.
It's such an important question, and it gets back to the core of the interest rate sensitivity of the US economy, as well as the other things that we've been doing possibly to offset tighter monetary policy. So to unpack both of those things, in taking the last one, we have to appreciate in the US, we're running a big fiscal deficit, 6.5% of GDP, which is arguably stimulative to growth on a nominal basis, so including inflation. So if you're running a big stimulative fiscal deficit, does that give you as much room to be able to cut interest rates from a monetary side of things and ease monetary policy? And so I think that has to be mentioned as this divergence in the path of monetary policies. But there's another really important one, which is that we think that the long tail of quantitative easing is the reason why the US economy has remained resilient in the face of these higher interest rates, and the reason why the Fed is going to be later to cut versus other economies. And what I mean by the long tail of quantitative easing is that after nearly 15 years of suppressing the long end of the curve, and then that fever pitch of the 10-year Treasury getting to 0.5% in June of 2020, allowing for the refinancing of a lot of debt, what that did effectively is desensitize the US economy to short-term interest rate hikes. And we can measure it by looking at the percentage of mortgages for consumers that were floating rate. Going into the great financial crisis, about 35% of mortgages were floating rate. Starting in the rate hiking cycle of 2022, 5% of mortgages were floating rate. That's made possible by keeping interest rates really low in the long end of the curve. You can show the same thing with commercial paper balances. Commercial paper balances used to be in that's very short-term debt, used to be a much bigger part of corporate balance sheets. Well, ever since you could borrow long at 2.5% for 50 years, like some companies did, you don't need short-term debt as much. So as the Fed has raised interest rates, what's happened is that you haven't seen an increase in interest expense nearly to the same degree that you have in prior cycles. But instead, you've actually seen a big increase in interest income. So companies and consumers sitting on cash. So the Bureau of Economic Analysis puts out a stat that shows net interest expense. So your interest income minus your interest expense. And shockingly, for the first time in modern history of hiking cycles, you actually saw net interest expense, so benefiting from higher cash and not as much increase in your interest costs, fall in 2023. It fell by 36% on a year-over-year basis at the low. So when you put that together, you can see, okay, that's why this economy has remained resilient. It's because we haven't really felt the brunt of these higher rates. It doesn't mean we won't feel the brunt of higher rates. We actually think refinancing cycles are still to come and could be a headwind, but I think it helps explain this divergent monetary policy. Just as a note, if you look at Canada, the UK, the European European Union, all areas that tend to have more short-term interest rate exposure, whether it's through corporate interest rate sensitivity through bank loans or through consumers with faster resetting mortgages than the standard 30-year fix that we have in the US.
Does that mean that bond holders, and we'll talk about yields and bonds now, does that mean bond holders are likely going to see some sort of, or have to have some sort of capital allocation outside of bonds and rotate outside if we see interest rates fall because their net interest income is going to fall as well?
The great cash on the sidelines argument.
Yeah.
Right. This, and cash on the sidelines is something that I've heard as an argument since 2010 is the reason why some asset classes would do better than others. And at times it's true. When you measure things like you can look at the AAII calculation of portfolio exposures, and what you can see is that at the low in the great financial crisis or the low in the 2020s, you saw consumers really shed stocks, meaning that they sold, they raised cash, they were scared, they said, get me out of the market, I don't want to be in here anymore, this is too much. But right now where you're sitting in those allocations is just about 2 percentage points lower than the peak that you got to in 2018 and late 2021 when people were all in on stocks, took all the chips and pushed them right in. And so I don't know how much of the money market balances are really fungible, meaning that they can be moved and allocated to stocks if we see the Fed cut rates and interest income starts to fall. I think more of it is that these have been bank account balances that have been sitting in people's accounts, not earning any interest, not having better options, but people still want the liquidity. So I'm not sure it all flows into stocks. Maybe at the margin it does, and that gets us back to that peak allocation. But it's a good question because we do know that there is an incredible amount of money market investments that are now yielding over 5%.
There's talk that the Fed will slow the pace of quantitative tightening, so taper the taper, so to speak. If they do start this summer to slow the pace of tightening, what will that do for the long end of the curve?
It's such a good question because we've seen the long end of the curve react in funny ways to tapering. You go back to the taper tantrum back in 2013, and the long end of the curve actually spiked higher on the tantrum than once we actually started tapering the purchase of bonds. So the inverse of the tapering we're talking about in the actual quantitative easing that you saw once that tapering started, bond yields fell for a time. So I think it has to be kind of the confluence of drivers here, which is that I would argue that Treasury funding does matter as well, in addition to the taper, but probably what matters most is growth forecasts and growth expectations, which just means that if we were to experience a period of much weaker growth, we would expect to see a rally in bonds. Then the big question is, if you see a period of much weaker growth, what does that do to the deficit and what does it do to the appetite for bonds? We saw a glimmer of what a low appetite for long end treasuries could do to the bond market in the third quarter of last year, where yields went very quickly from 4.5% to 5%. It seemed like in a blink of an eye on weak treasury auctions and this indication that more coupon debt would be issued. If we have another recession and you were to see kind of counter-cyclical spending and you see the deficit blow out even more, let's say go to 10% of GDP, and at that point, the Fed would likely be doing QE. So we're talking about a bit of different things here. But at this point, to sum it up, we do think that the 10-year Treasury is still in an uptrend, even after today, Monday's move, where you saw yields fall on the weaker PMIs. We do think that the 10-year Treasury is still technically in an uptrend. So we're disciplined about that. If it breaks, then we might update our call to expect lower yields.
So then do you ultimately see divergence between the 2 and 10-year? Let's say the Fed cuts rates sometime this year, assuming that they do. We can expect the 2-year to fall because that usually the short end of the curve usually tracks the Fed funds rate. But then we could see the long end of the curve, like you said, continue to rise, hence a steepening of the yield curve. Is that what you're expecting?
Yeah, I mean, it's a very possible scenario where the 2 year is falling in that classic bull steepener where the Fed is cutting interest rates and you're resetting the yield lower in that 2 year forward forecast. And I think usually during that time, if the Fed is cutting for a good reason, for a bad reason, because growth
Okay.
is weaker and people are getting scared about the future path of the economy, typically the 10 year would rally as well. It just wouldn't rally as much as the 2 year, which is why you get the steepening. When you put it all together, I think that there is still chance, given the dynamics around deficits, the dynamics around treasury funding, that you don't see the 10 year fall maybe as much as you normally would, simply because we're running such high deficits, even in a time when nominal GDP is really strong.
Is growth weakening though? Let's talk about some recent data releases. Well, this came in from last week. I'm talking about weekly jobless claims from the week of May 23rd. But claims fell 8,000, where they fell by 8,215,000. So the number of Americans filing new claims for unemployment benefits fell that week, pointing to underlying strength in the labor market that should continue to support the economy. This was from Reuters.
Mhm.
However, the report also says that the housing market is showing signs of losing momentum. So, how are you reading the recent from the labor market? I understand that weekly payroll numbers, are volatile, but the overall trend, what is that pointing to, Cameron?
Well, we have seen some kind of deterioration under the surface within the labor market. We still think that the labor market is solidly tight and healthy. However, if you look at the April non-farm payrolls, what you saw is a big slowdown in some of the cyclical components of the labor market. So you think of things like construction, manufacturing, leisure, and hospitality, all areas that had been growing jobs in a pretty robust way really slowed down in the month of April. When we get May data, we'll be watching really closely for those sectors to see if there's any evidence of sectors losing jobs. As of right now, it's just been a moderation in the jobs being added, not outright shedding of jobs. We would get concerned about the labor market if we saw shedding of jobs. But we're not making the call yet that we are going to see a very sharp deterioration in the labor market. However, we are noting that you are starting to see signs of stresses in certain areas. Like I mentioned, the PMIs that showed a little bit of improvement in the labor side of things and the employment side of things this week, but manufacturing activity still seems to be in the doldrums despite the hopes that you could see a rebound. You saw Chicago Fed manufacturing was really quite weak. Economic surprises overall, I think this is something to watch closely, have really plunged over the last month or so. And economic surprises are just an index that measures how economic data is coming in versus expectations. And when it's negative, it just means it's coming in lower than expectations. So our call isn't for one of some massive deterioration in the economy yet. We don't see signs of that yet. However, we're asking the question if the progress that we've made in raising GDP forecasts might be starting to lose some steam, might be coming to an end. Meaning you've gone from a 0.5% GDP forecast for 2024 at this time last year to 2.4% today. That's a huge upgrade to forecast. Do you continue to see forecasts move higher if data keeps coming in a little bit weaker than expected? Atlanta Fed GDP now has moderated a lot over the last couple of weeks. So it's not to say that it's some kind of dire end of the world. It's just to say that the market cares about where you are versus what expectations are. So expectations versus reality. And if reality doesn't meet expectations, that can be a source of volatility. And we think that that's one thing to watch as we move through the summer.
Well, let's talk about EPS now. I'm looking at, well, depending on which estimate you're looking at, but so far, EPS growth was around 4% year to date. Correct me if I'm wrong, but depending on whether you look at 5%, 6%, it's still much lower than what the S&P has grown, than what the Nasdaq has grown. And so we're looking at valuations outgrowing EPS actual growth year to date. Is that a worrying sign for you that valuations are becoming overstretched?
Yeah, it's valuations are a funny thing because they're a terrible timing tool, meaning that valuations can get stretched and stay stretched. We could make an argument a year ago and many percentage points lower, ago in the S&P 500
Right.
that valuations were stretched.
Yeah, I've been
And
hearing this since 2014, but yes, you're right. Yeah.
yeah, and the thing, if from a historical context, it's hard to get comfortable with valuations unless you're making a new regime argument. And the historical context is, if you look at forward PE multiples on the S&P 500, and for tech as the largest weighting the S&P 500, you're for the overall S&P, you're at about 20 times, which is a level that we reached earlier in the year and we rolled over. And it's a level that we've never gotten higher than, other than two different points in modern history. The first one being, of course, the tech bubble in the late 1990s, where valuations went much higher than 20 times. But also, we only went higher than 20 times back in 2020, 2021, during the COVID bubble, that policy bubble where you were absolutely flooding markets with liquidity. And to point, you also had earnings that had collapsed. So you tend to put higher multiples on collapsed earnings because you're going to get the growth in the future. And so when I look at today's multiple, it's hard to feel encouraged by it, but it's not enough to say I can't be invested, because it tends to be the kind of thing that simply amplifies the move to the downside, meaning that if we get a catalyst, and we could discuss what that catalyst could be, if we get a catalyst that causes people to go risk off and sell equities, the higher starting point of your multiple, the more room you have to fall. It's why back in the 2000s, you could have such a deep equity correction in what was a very mild recession, but you had priced equities to the proverbial moon. And so there was simply more room to fall. So that's where valuation comes in, is saying, be disciplined, don't chase, but realize that it can't be your timing tool because it can persist.
Yeah, what would that catalyst be?
I think it would be falling growth estimates. It's
Okay.
getting back to the EPS line and to the GDP forecast line. I think the more I think about 2022 and the reason why markets sold off so much, it was because the market forecasters really thought that as the Fed raised interest rates, we were going to have a recession, and you priced it into markets. And so people cut their estimates for GDP, they cut their estimates for EPS. And what's interesting, over the course of 2023, you reversed all those cuts and went right back to what your original forecasts were before the Fed had started raising rates. So I think that estimate cuts are something that causes a risk off kind of mood in the market, causes people to take money off the table, causes people to question higher valuations. So until we see signs that we need to cut GDP forecasts and cut EPS forecasts, that's why this market can keep chugging along. You start cutting EPS forecasts, I think it creates a very different story, given the fact that where valuations are, you've created a pretty high bar.
I've heard the argument that yes, valuations are a poor indicator of price, especially during this kind of market, which some people have told me is a momentum market driven by hype around AI and perhaps other tech trends. So, what are you looking at in terms of momentum right now? Is it waning or is it accelerating?
Well, I love that you pointed that out, because it's so easy when looking at valuations for people to make the "this time is different" argument, and we hear it all the time. I think the most recent one, other than today, of the AI driven growth of "this time is different," is you could go back to December of 2021, near peak of valuations, where Robert Shiller, who is the father of the CAPE ratio, the cyclically adjusted PE ratio, this idea of a long run valuation tool that allows you to see how extended you are versus history. The data goes all the way back, I think, to the late 1800s. And he comes out and he says, don't worry about high valuations. Yes, they're the highest they have been since the tech bubble, But compared to bond yields, which are so very low, the excess earnings yield you're getting on these high valuations is still attractive versus history. And lo and behold, it turned out that both of those things were in a bubble, meaning that equity valuations were too high and bond valuations were too high, meaning yields were too low. And of course, then that's how you got this massive bear market across the board in bonds and stocks in 2022. So sorry for the diatribe. I can actually answer the momentum question
It's
if you'd
fine.
like.
Yeah.
So I mean, on the momentum front, medium-term momentum still remains resilient, but we have seen daily momentum start to roll over. And I think it speaks to maybe expecting a little bit of chop in the near term. We like to use MACD indicators, moving average convergence, divergence indicators, just to measure where we stand on the momentum front. And what you can see is that there has been deterioration. Jeff DeGraff over at RenMac has also been writing and speaking a lot about momentum and how actual high momentum names have been laggards over the last couple of months after momentum hit a kind of peak in its outperformance. So all of that is to say is that we're being very disciplined around trend, and that you have seen some pretty big distributions. So things like software patterns breaking down high momentum names that are rolling over pretty hard and look pretty distributive. So clearly there's some shifts in market leadership under the surface.
We're starting to see utilities and defensives rally in the last couple of weeks. Is that an indicator for anything else?
So we've been asking if we should take the utilities move with a grain of salt, just because it has so much of the AI hope and dream that's being reflected in it, the build out of the grid infrastructure. And are you seeing people move into utilities in a classic risk off move, or is this a weird new way to get risk on through a different sector? The ratio I think is the most important one to watch is consumer discretionary versus consumer staples on an equal weight basis. So that way you take out the impacts of Amazon and Tesla, for example. And what you can see there is that ratio really rolled over the course of April and into May, but it started to rebound, and it's right at trend support. So that's an area I would watch that ratio extraordinarily closely, because if that breaks down, that's your signal that you're talking about, which is when discretionary underperforms staple. Usually that's an environment where we are cutting estimates for growth for the household consumption, which is 70% of GDP. So watch that ratio. If it breaks down, there could be some growth forecast cuts on the horizon.
And you wrote in a note that you said to me that tech has been flashing issues under the surface. Can you elaborate more?
Yeah, we've been seeing this really for the last 3-4 months. You started seeing it with hardware initially, which is pretty much all Apple. Apple is the largest weight in the hardware index by far. But the one that really made us a little bit uncomfortable was software. Software being supposedly this high margin place that's somewhat defensive, but still benefits from all of these great trends and spending growth and investments from companies. And what you started to see is software really rolled over on a relative basis versus the market. Some key names started trading below their moving averages and just lost steam. And it couldn't keep pace with the rest of the market that was soaring on semiconductors. And so if you looked at tech overall, you'd say, oh, the tech trend is great. It's amazing. But it was pretty much all just semiconductors and pretty much all just NVIDIA. You start peeling back the layers, you go, well, hardware's not so great. Software's not so great. And that's why, we weren't surprised when Salesforce came out and missed, and it was such a poor reaction, because you've been seeing this deterioration within software really for the last 3-4 months.
So is that an oversold play, you think?
It usually is a good thing to buy oversold conditions in uptrends, right?
Yeah.
Like when you have a solid uptrend. But what we've seen in some of these software names is that they got oversold, or their uptrends got violated a couple months ago, meaning that distribution started to happen. And so now they might be oversold, but it's in an emerging downtrend. So maybe it's a rally that you can buy for a little bit. meaning it's short-lived as it rallies back up into resistance, and not necessarily, an investment, because some of these things look like falling knives, where you're not necessarily seeing a robust trend that you want to buy into.
Have you considered looking at other markets outside the U.S.? The Hang Seng, for example, has not caught up with U.S. markets. Neither has the Japanese markets. Neither have the FTSE index companies. Right? It just seems like the U.S. is outperforming everything. And so, on a valuation basis, perhaps U.S. equities, or non-U.S. equities rather, could be a play. Have you considered that?
Yeah, so we debate this all the time because we've been underweight emerging markets for quite some time, and for good reason. The emerging markets and international developed markets versus the US have been in relative downtrends since 2007. Meaning that since 2007, you have underperformed the US. And at any one of those points, you probably could have made a valuation argument. And those valuation arguments even became more powerful, really, since, let's call it 2018, when US valuations started to surge, when growth stock valuations went through the roof. And so that valuation argument is always there, and yet these markets continue to be value traps. And the reason that they're value traps is a few things. Appreciate that a lot of these markets have much higher weightings to value-oriented sectors. So financials, materials, industrials, energy, old economy things, much less exposure to tech. And that leads to a lot of divergences in earnings. So one of the things that is the most shocking thing is that since the peak in 2007, you have seen the US grow earnings overall by about 160% since 2007 to today, meaning that we had the downturn in 2008, but peak to, let's say now is the peak to peak, 160%. Since 2007, the earnings growth for both international and emerging markets have been negative, meaning that they hit a peak in earnings growth in 2007 and have still not surpassed that peak. Now, I think international developed have just surpassed that peak. Emerging markets are still below it. That explains the underperformance. So for us, the catalyst to move more overweight international markets is when we can make a really strong earnings story that those parts of the economy are going to do better. It likely requires a weaker dollar, and B, possibly a commodity super cycle.
So ultimately, then, asset allocation. Can we comment on that? Are we still sticking to the 60/40, or are you doing something else?
Yeah, so a lot of our clients were high net worth, ultra high net worth investors. So we have the luxury and the flexibility to be able to invest in a lot of alternative assets. That's an area where we think that the due diligence burden is even greater than what you have in traditional asset classes. You have seen big new entrances in places like private real estate and private credit that have made their way into the market, big new funds that have been raised. And one of the things that we're seeing is a lot of new funds are coming to us saying, do you want to invest? And we're kind of being thrown a lot of product. And what we find is that these investments, of course, are much longer term investments, meaning that you can't put a stop loss on it and exit it right away. So you have the burden of staying with these investments for 5, 6, 7, 8, 10 years. So you have to do a lot of due diligence, but you have to have a great deal of confidence in your underwriting capability of the people making the investments. So we do a lot in a diversified alternatives. We still think it's a great place to be able to take advantage of market dislocations. Then within the traditional assets, we still have that balance between equities and fixed income, depending on liquidity needs. Most clients will have different kinds of liquidity needs that make us need to tailor portfolios and make them function for whatever their needs are. So then if we think within each asset class, right now our weightings are that we're overweight large cap, underweight small cap, neutral international, but overweight international developed, underweight emerging markets because of that earnings dynamic. And then when we look into the fixed income line, we have been overweight credit, but we're getting less and less comfortable with that overweight of credit. We've seen spreads really compress, get really, really tight, and back near to 2021 levels. And we're asking the question if we're being fully compensated for the credit risk we're taking on. We think that's an area of a high degree of selectivity as well.
And so how do you feel about treasuries?
So treasuries, we continue to have a lot of exposure in rolling T-bills and taking advantage of those higher yields. We do have longer term treasury exposure, but we are underweight duration, meaning that we have been positioned for rising yields, which we have enjoyed this year. However, we're looking at what would cause us. We've been buying, we've been extending duration, whether it's in treasuries or munis, into bond sell-offs. So when yields touched higher back in April, buying a little bit, allowing us to extend duration.
I've heard the argument that even at today's level, the 10-year yield isn't high enough to compensate for the 10-year duration risk. Is that something that you agree with?
Well, if it depends on what you assume the forward path for yields are. If you're worried that the 10-year treasury is going to go to 6%, yeah, then you will have losses overall, without offset the income. However, I think we noted that it's about 100 basis points further rise in the 10-year treasury in order for your yield to be wiped out. So, if we thought that yields were going up 100 basis points from here, no, we wouldn't be buying into treasuries. But just like we do with equities, when equity markets sell off, we want to be buyers for those that have cash that need to get allocated and are below their strategic allocations. And the same with fixed income. If we're sitting on too much cash and we see bonds sell off, you will be buyers and be able to be long-term holders and tolerate certain volatilities.
And based on the conversations you've had with your clients, are they more interested right now in growth or capital preservation?
Yeah, I mean, it's a good question about, what's the degree of FOMO
Yeah.
and how much are clients, sitting there going, oh man, I wish I got in. And we had a lot of that last year where clients, were saying, have I missed it? How do I get in? And, trying to set up systems to be able to take advantage of volatility and buy on down days and buy on pullbacks. Um, but I don't get the sense that clients are overly ravenous for that FOMO of saying, I just get everything invested, give me leverage, get me in. At the same time is that, I think that there is, some clients concerned that are business owners that you're starting to see some deterioration in growth, which might make them a little bit, less risk hungry.
Have you gotten questions about how to play the AI trend?
Yeah, look, everybody is curious and excited about the potential for changing technology, and we have in our equity strategies a fair amount of exposure to the semiconductor sector, our industry group, and with the benefit of it, it's sometimes blind squirrels. We bought the utility that's been soaring, that's benefiting from from this infrastructure build out. The one thing that we do caution clients on is thematic investing can often be lazy investing, and wanting for long-term investors, making sure that even if you were to remove the theme and the allure and the aura of that theme, are you still comfortable with the management team, with the balance sheet, with the free cash flow underwriting? And it's more than just this guy put AI in its conference call transcript 30 times and now the stock is soaring.
Yeah, finally, do you think investors or markets overall are pricing in the possibility of higher unemployment due to the rise of AI? Is that a tail risk event, or is that something that people are actually considering in their projections?
I don't think it's being considered at all,
Okay.
whatsoever. It doesn't seem to be. These technology changes. There's been concerns every time we adopted a new technology that you would see big layoffs, and what are the stagecoach drivers going to do now that you have cars, and you end up creating new industries around the new technology that tends to absorb the excess workers. I think that some people argue that this time is different,
Well,
meaning
wh-
that
which
this.
which sectors do you think would be most disrupted? Let's put it that way.
Well, it's so there's a couple answers to that.
Hmm.
The first one is that it seems that the creative types of like human intelligence
Hmm.
kinds of businesses will be disrupted, meaning that language is something that we have had the monopoly on as humans, and that now as computers are able to replicate our language better, then maybe there is more disruption in those kinds of industries. So think in legal and certain kinds of finance, creative work in media and that type thing. In manufacturing, we're far off from a robot being able to build a 737 on its own. However, we're now finally starting to see the benefits or the promise that was promised to us 10 years ago of things like machine learning and big data using these new AI tools. What I mean by that is that I remember 10 years ago, we had this whole big push of putting sensors on everything and then being able to do predictive maintenance. So that way you had less downtime of machinery and equipment. And everybody thought it was great. GE created an entire business around it. It was called Predix. And they said, well, we're going to save all our customers all this money and it's going to be great and good. And it ended up making some of the equipment more efficient, but it never showed up in the profitability of any of these companies. We're now starting to see a little bit more where AI is helping to make things even more efficient, but I don't know if it actually is going to make corporate profits in that manufacturing space higher. It seems like right now it's benefiting from the infrastructure build out, but not necessarily from the application of the technology itself.
Yeah, it's disrupting even the creative industry as well. I mean, we thought artists would be safe, but look at what Midjourney's doing. I think ballet dancers are safe though. I wouldn't pay to watch robot dancers.
Yeah. Who knows? I could be an AI.
You could be. We'd have to digitally sign off on this interview. Give us a fun fact about you that only you would know and a computer would not, and then we'll sign off here.
Oh goodness. I was in a Coke commercial as a kid. That was cool. So I auditioned for it and I got the part. That was really fun. And so
Do you remember what you said in this commercial?
yeah, it was Grinchmas themed, and it was for at Universal because I'm from Orlando
Right.
originally, and so it was all about Universal and Grinchmas and the whole thing. And
Yeah.
I remember the first time that CNBC ever called me to ask to come in for the interview, and the producer was like, "Well, have you ever done this before?" And I said, "Well, I was in a Coke commercial as a kid, so how hard could it be?" So I guess these things tend to come full circle,
Yeah,
but
you're a natural performer. All right, very good. Where can we
yeah.
learn more about your work and I guess NewEdge?
Sure. So I'm on LinkedIn and Twitter, Cameron Dawson. Go to newedgewealth.com. We have now a place to sign up for the weekly notes. And I think we're going to start sharing the Monday chart deck soon, which is a piece I do every week. That's a really deep dive into all the markets, give a good overview of what's coming up and get people prepped for the week.
Yeah, you sent me some really good charts offline, so we're looking forward to that. Thank you very much, Cameron. Speaking at soon. Thank you.
Thank you.
Thank you for watching. Don't forget to like and subscribe.